The Closing Process, Chapter 4, Wild 21st Edition. Using the chapter example, we will walk through the closing process from the adjusted trial balance to the post-closing trial balance. Here we have the adjusted trial balance. So this is after all of the accounts have been brought up to date and adjusted. They have been properly valued and expenses are brought up to date as well as revenue and matched, expenses matched with revenue. The entries you will need for the closing entries are needed to reset income statement accounts, which are income and expense, revenue and expense, as well as dividends to set them to zero. If you'll remember, our income statement is for as of the period ended for a month, a quarter, or a year. So it is a moving picture of all of the transactions for a certain period of time. The same thing can be said for the statement of owner's equity. It is as of a certain period. So you're capturing information from one time period to the next. But when you start the new financial statement period, all of those accounts must be zeroed out to capture new information for the upcoming period. So income, expenses, and dividend, all of those are temporary accounts and will need to be set to zero so they can begin to capture the new data for the new accounting period. However, all of the balance sheet accounts, which are cash through capital, those will remain the same because those are definitely associated with an asset or a liability which exists. So you can't zero out cash, accounts receivable, supplies, prepaid insurance, or equipment, nor can you do the same for accumulated depreciation, accounts payable, salaries payable, unearned consulting revenue, capital, because all of those exist. And they must remain so, and so the balance sheet accounts will never be zeroed out in the closing process. So let's look at how this works. First of all, you will do the same steps for each time you close the books. So you will debit all of the consulting revenue. This is the consulting revenue. As you can see from the adjusted trial balance, it's a credit-based account, and that is its normal account balance. But in order to zero it out, we will debit those, and we will use an account called the income summary for all of the income statement accounts as a type or a way to, in order to help clear these accounts. So in other words, we don't want to book all of these journal entries into capital and muddy the waters as to what's taking place in capital. So we're going to use the income summary account as an account to help us close out the accounts. So we're going to credit income summary for the total amount of the debits associated with revenue. Next, we're going to do the same thing for expenses. Expenses, as we can see from the adjusted trial balance, are all debit-based, which is their normal account balance. And again, normal account balance means what side, whether debit or credit, increases the account. So all of the expenses increase with the debit. So when we're closing them out, we're going to credit each one of these accounts. Then we'll take the total of these credits and we will post them to the income summary account as a credit. And again, if I'm going too fast, pause the video, look at it, and then pick it back up when you feel like you're up to speed with what's transpiring. Next, we're going to close out the income summary account. So we're going to take the balance in the income summary account, and this will be seen more clearly when we look at the T accounts or general ledger accounts associated with income summary. But we're going to close this account since it's temporarily used to help us close out all of the income statement accounts. So we're going to close this out to capital. And so this $3,785 will be closed out to capital. But if you think about it, it's actually going to be the balance of what should be net income when you look at the income statement, because this will have been all of your revenue in the income statement, and these will have been all of your expenses. So the net amount in the income summary account will be net income, but you'll see that more properly when we look at the T accounts. Lastly, we said that not only do we want to close out the income statement accounts, revenue and expenses, but we also want to close out the withdrawals account. So that is going to be closed to capital. So normally it's a debit-based account, so we're going to credit it and credit the amount to capital. So all of the income statement accounts and the statement of owner's equity accounts are going to be closed out to capital, which is a balance sheet account. Now let's look at that in relationship to what's going on in these individual account balances, and I've just captured the ones that are associated with the closing entry. So we have our beginning balance in capital, we have what we're booking now to income summary, and we're just using this temporarily to help close the book, so that's the credit to the income summary. And now we can see that we have these debits, one to consulting revenue, one to rental revenue. When our debits equal our credits, it means that our balance is zero. Debits equal our credits, so our balance now for consulting revenue and rental revenue is zero. Let's do the same for the expense accounts. So now we're going to debit the income summary account for all of the expenses. So we're going to credit rent expense, credit salary expense, utilities expense, insurance expense, supply expense, and depreciation expense. All of the debits will equal all of the credits, so for each one of these accounts, their balance will be zero, so we've zeroed these out. Next, we have a balance in the income summary account of $3,785. So our next journal entry, and this is what we'll do every time, is we want to go ahead and do a closing entry to close out the income summary account. So that'll be $3,785. So our balance before this was $3,785. This closing entry is $3,785. The debits from the balance, taking into consideration our new debit, means that our $3,085 in debits equals our $3,085 in credits, so this will be a zero balance. And we're going to use the capital account in order to close out the income summary, and that's the purpose of the income summary, is to be able to get this amount here from the income summary into the capital account. I know I used a lot of words to explain that, but we just want to credit the capital account for the amount associated with closing out the income statement accounts. Next, we want to go ahead and take capital and withdrawal and close out our withdrawal account. So we have a debit balance in withdrawal. We're going to credit it, and so now there'll be a $0 balance in withdrawals. And now our second closing entry to capital will be to debit capital. So now we have these as our total debits to capital, these as our total credits to capital, and our ending balance in capital will be $33,585. So let's look at how that looks with reference to the post-closing trial balance. So here we have the adjusted trial balance, and we can see that cash is the same, accounts receivable, supplies, prepaid, and equipment, accumulated depreciation, accounts payable, salaries payable, unearned consulting revenue, but now we can see we have a new amount for capital. Originally we had $30,000, but as a result of clearing out and zeroing out all of our withdrawal, revenue, and expense accounts, we see we have a new balance that's been calculated in capital of $33,585. So now that is our balance in capital, $33,585. This is the post-closing trial balance. So we can see that there is a zero balance for withdrawals, revenues, and expenses. So the only thing that should remain on a post-closing trial balance are all of those accounts which are balance sheet accounts.